Warren Buffett bet $1 million in 2008 that a hand-picked group of hedge funds would not be able to outperform the S&P 500 index over a 10-year period. Buffett won the bet in 2018 and walked away with an extra $1 million. This revealed a major problem in the investment industry. Actively managed funds, particularly hedge funds, fail to outperform the overall market. When expenses are taken into account, only a few funds have returned money to their investors in excess of what they would have gotten had they just followed a more traditional investment strategy. Hedge funds appear to be ineffective. So, why do wealthy people continue to invest in them? But before I answer that, please accept my warmest greetings if this is your first time here at the Smart Stocks Academy channel. To be the first to know when a new video like this is released, hit the like button, subscribe, and click the notification bell next to it. So if you're ready, let's get to the video. Hedge funds are likewise not open to the general public. In order to invest with one of these institutions, you must be an accredited investor. What qualifies a person as an accredited investor varies by country, but in the United States, it is a person with an annual income of $250,000 or more, or a couple with a combined annual income of $300,000 or more. This income must also have been sustained over the previous 2 years. If a person or couple has a net worth more than $1 million, excluding their primary house, they can become accredited investors. Finally, you can be an accredited investor if the unregistered business you're investing in has a director, executive, or general partner. Simply said, this is to allow people to invest in their own startup. To invest in risky assets, you must be an accredited investor, as the SEC aims to ensure that inexperienced investors are not taken advantage by unscrupulous financiers pitching intricate financial products with high costs and little returns. Even if you are an accredited investor, most hedge funds will make it difficult for you to invest. The majority of hedge funds will require a minimum commitment of $100,000 to $1 million. Ray Dalio's Bridgewater requires a minimum investment of $7 million and can cost up to $4 million per year in fees alone. But since people this wealthy aren't stupid, why would they invest in hedge funds, which have historically underperformed on a more fundamental investment strategy? Let's imagine you launch a multi-million-dollar business and find yourself with more money than you know what to do with. Investing is likely a solid alternative. No business can endure forever, and intelligent investing can prepare you, your children, and their children for a life where they only work when they want to. You have a lot of options. If you want to be secure, bonds have historically been your best bet. However, with interest rates as low as they are right now, that isn't a very appealing option. Crypto is dangerous and unproven, and it is difficult to establish a legacy on a foundation that's barely been existing for a decade. Finally, the two most common investment options are real estate and stock market. They are popular for a reason. They provide excellent returns and have done so for as long as capitalism has existed. It is now easier than ever to enter into, particularly if you have millions, if not billions, of cash in your bank account. Hedge funds, on the other hand, are a completely different story. On the surface, they appear to be nothing more than a go-between for you to invest your money directly on the stock market. A middleman will take a large percentage of any future profits. So what is the point of all of this? The first error is to believe that this is an issue. Warren Buffett's famous $1 million wager may have tarnished hedge funds, but it revealed nothing that sophisticated investors didn't already know. So what if the market outperformed these funds? Does this mean that bonds are lousy investments because the market beat bonds and real estate over the same time period? No, they are not the same. They're just different. The second blunder is to believe that all hedge funds do is invest in stock. Some of them do, but not all of them. They also don't invest in the same way that a normal person would. When you and I acquire stock, we normally intend to retain it for a long time because we believe it will appreciate in value. We might even short a company if we believe it is overvalued, and likely to decrease in price if we want to get technical. Some of us will even dabble in stock derivatives like options, but all know it is nothing more than legalized gambling at this point. Whatever we do as individual investors, we are just betting on the price of a stock going up or down. Historically, the gamble that most companies will increase in value over time has paid off. So buying low-cost index funds and never selling them has become conventional financial wisdom. Some years will be better than others, but as long as a diverse enough portfolio and a long enough time horizon, you will almost certainly make money. For 99% of the population, this is excellent advice. It may be a very effective wealth development strategy when combined with some real estate holdings and a small dip into Bitcoin and alternative investing. The 1%, on the other hand, requires something more. Wealth that continues to grow regardless of market conditions. Market risk, as defined by investors, should be avoided by good hedge funds. This is the risk that an investment entails as a result of widespread market downturn. Almost every public stock, with the exception of a handful, is susceptible to market risk, which means that if the market falls, the stocks that make up the market will fall with it, even if the underlying companies are performing well. There are two methods to avoid the risk. The first is to simply wait it out. This is why they always advise investing for the long term. The other option is to protect yourself against market risk. This is quite difficult to accomplish, but let us look at a small example. Steam is expected to dominate the video game market on PC and consoles, according to a hedge firm. With this information, they will purchase shares in Steam as well as short and equal value shares in a group of other firms such as GameStop. This means that if the market falls, the losses from their Steam position will be offset by their short holdings in other firms. They'll have hedged their bets, as the name implies. If Steam then announces a partnership with Sony, Microsoft, and Nintendo to be the exclusive distribution platform for all video games, the stock price will rise in comparison to these other firms, and they will profit from the announcement while avoiding market risk. This still has the potential to go catastrophically wrong. If internet meme lords determine that GameStop is their favorite, the hedge fund will lose money on that bet. But that is irrelevant since it is just ordinary speculative risk, which is irrelevant as long as it is not market risk. So why is it critical to eliminate market risk? Because the wealthy are already exposed to such risk through their businesses and other assets. Because most traditional investments are still associated with the stock market, it is difficult to diversify away from market risk. The impact of a stock market crash on real estate prices is likely to be negative and vice versa. Uncorrelated return streams are sought by the wealthy. If a hedge fund is having a bad year, the market should be doing better. If the market is down, the hedge fund should be doing better. Investing in a collection of uncorrelated investments is unexpectedly more potent than merely picking the best performing investment over time. This principle's arithmetic is difficult, but it ultimately boils down to a concept called dollar cost averaging. Dollar cost averaging posits that an investor puts a certain amount of money into their portfolio at regular periods, regardless of market conditions. They will invest in the same amount when the market is up when it is down. This means that when the market is down, the investors buy more assets than when the market is up, which immediately fulfills the buy low aspect of the investing golden rule. When you have uncorrelated assets, something will always be performing well while something else is doing poorly, allowing you to fully leverage dollar cost averaging. Because most people invest for a specific goal, such as retirement, the breadth of their investments is less important than the breadth of their time horizon. Rich people prefer to be able to access their money fast, so that they can take advantage of opportunities as they arise. If a millionaire is offered an investment in the next Facebook, he or she will not turn it down because they are frightened of liquidating their holdings while the market is down 30%. Another reason hedge funds are still operating today is the wealthy individuals prefer to believe that they can identify a winner. Investing in a hedge fund is more like investing in a private company than it is like investing in the stock market. Most businesses fail, and most hedge funds underperform the market. But if you were fortunate enough to invest in the Medallion Fund when it first launched, would almost certainly be a multi-millionaire today. That's plenty of incentive for many wealthy people to write a few checks to promising new hedge fund managers with a solid investment thesis. Hedge funds are no longer as popular as they were in the 80s and the 90s. Instead, billionaires are flocking to private equity. However, there is still a reason these companies exist. They provide a very specialized type of service to a very unique type of person. And with that, today's video comes to an end. If you haven't already, hit the like button below to show your love and support for this video. Also, subscribe to the channel by clicking the subscribe button and turning on the notification bell next to it to be the first to know when a new video is posted. Thank you for stopping by to watch, and we hope you had a great time. We hope to see you again on our next video.